Good morning. Happy, happy Monday. Holy moly, that was weird. Okay, cool. There's that. Is it though? There we go. Okay. Happy Monday. As always, I'll give everyone just a few minutes to jump in, get the little notifications that we're live, and join us. There we go. And I like to open you guys up in the bottom corner too, just so I can see you in all the places. Okay. Oh, that's not it. Oh, that is it. Okay. Yikes. All right. I now trust StreamYard to give me all my comments. I didn't used to, because I think when I was on the free version, I don't know, like it didn't carry my Facebook comments, like your guys' Facebook comments over into the viewer comments. So I had to like have Facebook open in one area, and it was weird. So, but yeah, we're getting there, right? So, I'll give everyone a few minutes to jump in here. How's everyone's weekend? As you jump on, let me know what you did, if you did anything fun or exciting. What did we do? I worked because we got one more tax deadline coming up, and I got a bunch of other stuff that I'm getting ready for y'all. So I worked, not a lot, but I did work this weekend. I had birthday lunch with my best friend, who I hadn't seen in a couple months, so that was fun. And what else did I do? We decorated for Halloween, duh, like big deal. So my kids don't want to trick or treat this year. My daughter is not all about the germs, and my son, he doesn't really do candy anyway. Like trick or treating, we've done it with him, but it's never been his thing. Like he does it, but he lasts like a half hour and he's like, "Are we done yet? Are we done yet?" Which I don't blame him, because he doesn't really eat candy. So it's like, yeah, go spend time slaving for your sister, I guess. Yeah. So that's that. All right. People are starting to jump on now. Cool. So we decorate. So we told them, we asked them if they didn't, since we're not doing anything for Halloween this year, if they wanted to take their costume budget and buy new Halloween decorations instead, because we have a decent amount, but there's always room for more. So we decided to do that. They were up for that. So we went shopping, went to Party City and Michael's and somewhere else, I don't know, and got some new Halloween decorations. We went to Tokyo Joe's for the first time since March, because the one by our house has been closed. So Michaela was super stoked about that. It was just a good family night. And then yesterday I watched football. I watched Tampa Bay win. I'm a Brady fan. The Broncos weren't on. They were on last Thursday. And I watched Dallas lose. I'm sorry if you're a Dallas fan, but I root against Dallas about as hard as I root for the Broncos. I just can't stand them. So, all right. So we will go ahead and jump in. I think I've given everyone enough time to jump in. So we'll go ahead and get started. So I'm happy y'all are here. If you do not know me, I am Bree Beers of Bree Beers and Associates, and I am a CPA with the goal of enlightening taxpayers and business owners on all things accounting and tax. I understand that y'all don't know what you don't know, so our team is dedicated to creating all the tools we can to help you shed some light on that unknown. One of those awesome tools is our amazing Facebook community, Money, Tax, and Finance for Small Business. If you're a small business owner and you're not in that group, why not? It's free, it's full of advice and friendly people and just a real sense of community, so head on over there and join that. Excuse me. And whether it's in there or on YouTube, you can watch our live Monday trainings right now at 9 a.m. Mountain Standard Time, and then on Thursdays at 2 p.m. Mountain Standard Time. Yes, we do live updates and Q&A for y'all. So head on over there. If y'all ever cannot make it live or you want to watch and find a past training, all of those are in the video section of Money, Tax, and Finance for a Small Business Facebook group, or you can watch most of them on the YouTube channel, which is where I like to watch things because I find it's easier to search over on YouTube. All right, y'all. So today is part 3 of our retirement series. So today we are going to compare some of the retirement plans that we've talked about the last 2 weeks. And I didn't bring my water down. I'll be fine. And I'll give you a couple at the end. I'll give you a couple creative outside of the box options that you can dig deeper into and discuss with your financial advisor, just to kind of let you guys know what's out there. All right. Again, as always, hashtag not a financial advisor. I am a tax strategist, tax advisor. So everything we talk about today, that we're going to talk about today, is going to be high level or from a tax perspective, which is how the last 2 weeks have gone as well. So I will, I'm hesitant to share this with you. So I made this chart like late last night and it hasn't been like prettied up. I don't make pretty things. I put information together just so I can read it and understand it. But I was like, oh my gosh, this is going to be so good. So I asked my VA to pretty it up this week. And so so I can give it to y'all. So I will share my screen with the ugly one. I'm embarrassed. No, I'm not. It's fine. This one? No, this one. All right. So again, pardon the ugliness. There is a link in the description. If you want this in pretty version that Sarah will make for us, if you get on that wait list, if you click that link, get on the wait list, and I'll send it to you as soon as it's beautified. For your pleasure, your reading pleasure. No, it's like a cheat sheet, you guys. All right, so we talked about, over the last 2 weeks, we talked about SEP IRAs, simple IRAs, 401ks, solo 401ks, and traditional Roth IRAs. So we talked about, 2 weeks ago, we talked about IRAs. Last week, we talked about 401ks. So today, I kind of want to just wrap it all up and just kind of look at them side by side, so you guys can kind of see what certain plans have and what other ones don't. Okay, so all right, I don't need to scroll over there. I need to scroll over here. I'm on multiple screens, so we're fine. So here we go. So let's start with your primary advantages of each of these retirement plans. All right, so your SEP IRAs and your simple IRAs, and even your traditional Roth IRAs on the far right, they're all really easy to set up. They're easy to maintain, and they have low administrative costs. Okay. And with your SEP IRA, you guys, and with all of these, the reason you set up retirement plans, you guys, is so that usually it's a tool for you guys to contribute to your IRA, right, or to your retirement, this year, right? So you're contributing to your retirement so that it can grow and make interest and be more when you retire, right? And most of these are going to be a tax deduction in this year, okay? And in most cases, when you take it out when you retire, all right, that's when you get taxed. So most of these retirement plans are what we call tax deferral tools, meaning you don't pay tax today, but you're going to pay tax on your original principal contribution and any interest when you take it out during retirement. Okay, so that's what we mean by tax deferral. So all of these are tax deferral tools, right? Meaning tax benefit today, pay your tax when you're retired. All right. The main advantage for all of these, you guys, the reason it's so you can save, right? And then you can grow interest and grow your retirement savings, right? But then you want to slip into one of these types of plans so that you can see a tax savings now, today, all right? And usually in theory, you guys, what the thought process behind most of these is that you're going to be in the same or a lower tax bracket when you retire. That's generally speaking. But even if you're not going to be, right, even if you're in the lowest tax bracket now and you hope to be able to retire and live large later, you're still making interest, which is free money, right? You didn't do anything to earn that interest except for invest, all right? So paying tax on all that money later when you actually have the funds to do so makes sense. All right, so that's what we mean by tax deferral tool. And all of these are tax deferral tools. Shoot, Wendy, I will add it at the end. I can't do it while I'm talking, but I will add it at the end. I wonder, doesn't matter. Wendy says she doesn't see the link, but would love to have a copy of this. So I will put the link in after we're done. Sorry, guys. I like to think I'm tech savvy, but apparently I'm not always. So tax deferral tools. So with your SEP and your simple, like we said, easy to set up, easy to maintain, low administrative costs, and their tax deferral tools. The SEP IRA, you guys, that first one, your SEP IRA is a tax deduction to your business in the current year. So those SEP IRAs, and again, if you missed this, you want to go in more in depth, it was 2 weeks ago. Your SEP IRA contributions are made by the business. Thank you, Lisa. I don't know why I yelled at you, like you're across the room. So your SEP IRA is a tax deduction to your business in the current year because the SEP IRA contributions are made by your business, okay? The simple IRA, all right, there's two parts to that. There's your employee and your employer contribution. So the employer portion is also tax deductible in the current year, okay? And then the 401ks, you guys, so 401ks, and we'll talk about what businesses these are ideal for in a minute, but these are usually bigger businesses because they are employee driven, okay? The employee contributes a certain amount, and then the employer may or may not match it. As the employer, if you're matching, that's going to be an additional tax deduction to you this year. As the employee in the 401k program, again, it's a tax deferral. You're using your earned income, right, from your W-2 wages, and you're putting it into your savings, so you're deferring the tax on that. The solo 401k has two parts again, and I think I missed this, but I'll add it when I give you the final version. The solo 401k has the employer and the employee parts as well. So the employer portion is a tax deduction to the business in the current year. And then the employee portion, you are the employee in your business, right? As the business owner, that's a tax deferral. All right, the reason I put the traditional Roth IRAs kind of by itself, separated over here to the right, is because traditional and Roth IRAs, you guys, those aren't business driven at all. They're not run through your business. They're not salary deductions. They're nothing. They have nothing to do with your business. They are individual. Okay, they are an individual contribution. Okay, so again, same thing, easy to set up, easy to maintain, low administrative costs. You can set up a traditional Roth IRA with most of your big banks if you don't have a financial advisor that you work with. I want to reiterate, and I talked about this 2 weeks ago when we talked about our IRAs, you guys, but Roth IRAs are actually tax savings tools, not tax deferral tools. And so with a Roth IRA, and I know I talked about this 2 weeks ago, so sorry if I'm being repetitive, but I think it's super important. So all of these other deferral programs, all of these other retirement, right? You put the money in now, they're pre-tax dollars today, right? So that's either a deduction or you don't pay tax on the contributions you make today. And then 10, 20, 30, 40, 50 years down the road, whenever you retire, you start taking that money out, that's when you pay tax. And you're going to pay tax on the principal, your original contributions, and all the interest that has grown. Okay, so it's all income to you at that point. With a Roth, you use post-tax dollars today. So there is no tax deferral. Okay, it's you pay tax today. Okay, but then all of the interest that you earn between now and when you take it out when you retire, okay, and the principal when you retire in 10, 20, 30, 40 years, all the money you take out of a Roth comes out tax-free, which means there's no tax savings on your principal, right? Because you paid the tax on it when you put it in, but all of that interest you make, okay, over the 10, 20, 30, 40, 50 years that it's growing, all of that interest, you guys, is tax-free income to you. Okay, that is why you hear so many people talk about how great Roths are. Okay, even if you're in a high tax bracket and you can do a backdoor, we talked about these or whatever, the fact that they can grow tax-free, the interest can grow tax-free is huge. It's the only one on here that's a tax savings tool, not just a tax deferral tool. All right. Oh, Facebook user, I wish I had Facebook open because I don't know who it is, dang nabbit. But it says, and for the love of all money, if your employer has a match, take advantage of it. Agreed. And that can be a simple match or a 401k match or any type of retirement match. If your employer matches you dollar, some of them do dollar for dollar, some of them do a percentage. A very common, and we talked about this last week, a very common one is 50 cents on the dollar with a max of a 3%. match. So what that means is you as the employee contribute 6% of your gross pay, right? And then the employer gives you an additional 3%. Y'all, it's free money, okay? Free money. Okay, so tax deferral is great, but when you're willing to get free money from your employer, hello, do it. And again, as an employer, as a business, the reason you do this is client retention, appreciation. You know, it's a perk of the job. And that matching is, again, a tax deduction to your business. All right, I got to go a little faster if we're going to get done on time. So what businesses are these ideal for? So the SEP IRA and the solo 401k are both ideal for businesses who have no employees, okay? Or their only employee is their spouse. So for a solo 401k, you cannot have any more employees. It has to be just you or you and your spouse. A SEP IRA, you can have other employees, but you got to keep in mind that whatever you contribute to whatever the business contributes to your retirement, it has to contribute that same percentage to everybody's. All right, so if you max it out at 25% of your compensation, you also have to contribute 25% of everyone else's compensation. Okay, so SEP IRAs are really ideal for people with no employees. All right, unless you are big on, yes, let me contribute 25% to your retirement as well because I love my employees and you're awesome and here we go. That's different. Okay, but there are not a lot of businesses out there that are that generous. Sorry, me included. I want to get to the point where I can contribute all that to my employees. We're getting there. We use a simple IRA. So simple IRA, who's this ideal for? This is ideal for businesses with less than 100. You have to have less than 100 qualifying employees. All right. So that's the difference between a simple IRA and a 401k. They work very similarly, but a 401k is usually for those larger corporations. And the reason for that is because there's higher admin fees, there's just higher fees involved. With the simple IRA, there's not a lot of admin fees involved. So it's really good but you have to have less than 100 qualifying employees. And this one, the employer matches up to 3% of what the employee puts in. And we'll talk about that. I'm jumping ahead. Sorry. And we already talked about solo 401k. And again, the traditional Roth IRA says NA because that's not a business. Those aren't business accounts. Those are individual accounts. So who makes the contributions, the employee or the employer? All right. So with a SEP IRA, sorry, I'm looking at both because now I'm cut off on my copy. Y'all just keep looking at your ugly copy and I will look at my even uglier copy. There we go. Made it bigger. Here we go. So who makes the contributions? So with the SEP IRA, it's an employer contribution of 25% of compensation, or it ends up being 20% of your self-employment income if you run a Schedule C. All right, for the simple IRA, both the employer and the employee make contributions. The employer will match up to 3% of the employee will match up to 3%. That's written wrong. Hold on, it says but it's not of the employee contribution. It's required to match up to 3% of your compensation. Nope, reverse that. I was right the first time. Sorry, only had one cup of coffee so far. What that's saying, if me as an employee, let's say I just want to max out, because you'll see the employee can make a $19,500 deferral in 2020. So let's say I'm like, yes, that's me. So I decide, I figure out what 19,500 is divided by however many pay periods I have. I said, okay, that's how much I want to defer of my compensation. Well, let's say that ends up being 5 or 10% of my total income, right? The employer is only required to match 3% of your gross compensation. All right, that's what I should have said. I will fix that. That's terribly written. And this is why y'all don't have the copy yet. All right. So then we get the 401k. So the 401k, your employee can contribute up to $9,500 is the tax-free deferral, pre-tax dollars. And the employer has an optional match. And then the solo 401k comes back to very similar to the SEP, right? 25% of compensation or 20% of self-employment income. And then the employee can also contribute $19,500. So that right there, and I need to add that. So the big difference between the SEP IRA and the solo 401k is your employee contribution. Okay, so with the the employer is the same, right? You look and the employer can contribute the exact same amount, but an employee, I'm just gonna add this real quick because, why wouldn't I just do this while I'm on a live? Employee up to, it's only a $6,000 referral. So that is where your solo 401k is going to be more beneficial than your SEP if you want to make a higher employee contribution. Okay, and then we get into the max annual contribution limits. Okay, for your SEP IRA and your solo 401k, again, it's $57,000 total. Okay, and this is between the employee and the employer portion. And then if you go to the simple IRA, it's $13,500. You'll see that it says $16,500 if you're over 50. And most of these, you guys have what's called a catch-up contribution that's allowed. So for the simple IRA, you can make that additional $30,000 contribution if you're over 50. If you are, okay, sorry, there we go. I want to make sure you guys can still see the headers. I wonder if I can make this smaller for you guys so you can see everything. Hello, there we go. I hope that's not too small. I want you guys to see the whole chart so you can still see the headers. Okay, and then so for the 401k, let me look back over here. You can make an additional, so your employee deferral, $19,500. If you're over 50, you can actually make $26,000. Same for the solo. So if you're over 50, you have what's called catch-up contributions that you can make. For the IRAs, for the individual side of IRAs, you can make an extra $1,000. So you'll see that in the last column, where you can make a $6,000 contribution, $7,000 if you're over 50. Okay, so if you're over 50, very important to keep in mind. All right, and then finally, we want to talk about the deadlines. So for your SEP IRA, your account has to be established and funded by the date your tax return is filed. You guys, this is big. So if the end of the year comes and you're like, for some reason you didn't sit with us or your CPA for tax planning, wink, wink, and you're like, oh my God, my tax bill is huge. How can I minimize it? Well, ask your tax accountant, well, what happens if I make a SEP contribution, and see what that does. All right. For your simple IRA, you have to have the accounts established by October 1st of this year. So you would have already had to have your account established, and then it just needs to be funded by the time the tax return is filed. 401ks need to be, and solo 401ks have to be established and funded by the last day of the year. And then in the last column, your individual traditional Roth IRAs, you get to fund it all the way up until you file your tax return. All right. And okay, I think that's it for the chart. So I want to just end, and this is going to be really, really fast, with the outside the box retirement ideas. All right. So again, hashtag not a financial advisor. So I'm going to give you a few things that I've seen my clients use that have, provided tax benefits. And these are things for you guys to just ask your financial advisor about. And here's what I want to tell you though. If you go up to your financial advisor, like, hey, my tax advisor mentioned, let's just go with the first one, REITs. Can I invest in a REIT? And we'll talk about what that is in a second. And your financial advisor says no. A good financial advisor is going to tell you why it's not a good fit for you. Okay? Because just like there's there's accountants, right, that specialize in different things, and tax accountants that have different areas of expertise. Same with your financial advisors. Okay, so you may have a financial advisor right now that when you say, I want to invest in a REIT, they may not do REITs. Okay, so they may be like, no, you don't want to do that. Don't take that. Okay, ask them why. All right, because just because the financial advisor you're working with doesn't offer something doesn't mean it's not a good fit for you. Okay, so make sure that you're getting the answers based on your picture, not based on their expertise. All right. And a good financial advisor will tell you, you know what, I don't really deal with REITs. That's not something I invest in. And that for my clients, and they may tell you why, and this is why. And then they're going to give you reasons, and you may be like, you know what, that is me. So maybe that isn't a good fit for me. All right. But if they're just like, we don't do it, like, make sure you dig into why. Okay. So the few things I want to talk to you guys about, or mention to you guys, just to make sure you have these in the back of your mind when you meet with your financial advisor. So REITs are, so first of all, I want to say invest in real estate. buy real estate properties, you guys. I know people are like, I don't want to be a landlord. Well, then that's not, you don't have to be a landlord. Buy a lot of properties eventually and have a management company. Or you can invest in what's called a REIT, a real estate investment trust. And what that does is you end up being a partial owner of a piece of real estate. This is done through your financial advisor, usually. All right. There's also life insurance policies that can be used as retirement tools. Same with annuities. Again, annuities, you are going to get both of these, life insurance and annuities specifically. You're going to get different thoughts from your financial advisors, because most financial advisors that like life insurance and annuities are either bigger because they have a lot of different branches, or they specialize in these things. And again, not everything is good for everyone. So work with your financial advisor to figure out what is good for you and your situation. And then the last one I want to mention, you guys, are self-directed IRAs. All right, so everything we talked about at the top, right? We are usually under the assumption that we're doing this through a financial broker, right? We're doing this through an advisor. Whether it's, Merrill Lynch or Fidelity or Chase, or is it Chase? No, JP Morgan. That's what it is. All right. So normally, however we're investing IRAs, 401ks, we're doing it through a brokerage firm, through a fund house. All right. But with a self-directed IRA, you can actually take those pre-tax dollars, okay, your pre-tax, your SEP IRA, your simple IRA dollars, and invest them into, like a self-directed IRA, you can invest them directly into a piece of real estate. Okay. Again, I wouldn't do this without the advice of somebody other than me, because I'm just a tax accountant. But a lot of financial advisors, again, they push away from this. You say, hey, I want to talk about a self-directed IRA. And they're like, no, you don't. Because first of all, it doesn't go through them, right? So why would, but even a good financial advisor that you have a good relationship with isn't going to deter you from a self-directed IRA because of the dollars. They're going to tell you why a self-directed IRA is harder, why you have to make sure you're crossing your T's and dotting your I's and all the work that's involved with it, and make sure you're well aware of what you have to do to stay, can't think of the word, to stay, it's on the tip, good, to stay on top of being legit, there we go, with a self-directed IRA. And then finally, a last little tidbit, you guys, and we will talk about employing your kids in just a few weeks. I want to say either the end of October or the very beginning of November. We are going to talk all about employing your kids as a tax deduction to your business. If you employ your kids, open a Roth for them and use part of their earned income to fund that Roth now. Because again, it's pre-tax dollars, but when you have a 14, 15, 16, 17-year-old kid who's working for you and you're contributing even $1,000 or $2,000 a year, okay, by the time they retire, holy crud, are they going to have a whole bunch of tax-free money? Okay, thanks, mom and dad. Boom. All right, so let me see. Facebook user says, I bought 5 rental properties for cash when the market was down between 11, 13, managed myself, sold in 18, 19, paid off the house and put significant cash in bank towards retirement. Love real estate. I don't disagree. Part of that though is because my husband, not because he's a real estate agent, but because that is his plan for retirement. He's like, we are going to invest in rental properties. So that's like where he's going. And then I'm like, let's max out all of our, Roth and simple and all these things type thing, right? So the two of us together got to you hear diverse portfolio, right? You don't want to invest all in one thing. So that's a way to diversify your portfolio. All right, just a few last minute or end of the day announcements, right? We have one more tax deadline, okay, for 2019, October 15th. That is next Thursday. If you have not filed your C Corp or your individual tax return, all right, you got to do it by next Thursday, October 15th. Remember, I've said this for like the lives for the last 4 weeks, even if you cannot pay, if you're avoiding it because you're like, I cannot pay, I know I'm going to owe money, I can't pay, file it, okay? File it and then call the IRS and get on a payment plan because you will pay interest, but interest is 0.5% a month, okay, guys? Failure to file penalty is 5% a month. All right, so please, 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 please get your return filed, okay? And to get your documents into us for timely filing, but there are accountants out there that I'm sure are okay helping you. And if it's something that's simple, you can do it yourself. But however you want. I know Wendy's on here. You can contact Wendy. Wendy will let me know if I'm lying, but I think she can take on a few more clients. At least she could last week. But there are still plenty of opportunities to work with us if you love us and want to work with us. 2020 tax planning will begin in November. I've been talking about this for 10 months now, and I'm so excited to finally get to start 2020 tax planning. Email list, because starting this week is when we'll start funneling out information to you guys about what tax planning is, what you guys are going to need to do, all those things. And then finally, if you're a PPP or EIDL borrower, remember, we have 2 options that we can help you with. Oh, Wendy says nope. Sorry. Oh, no, now you'll take them. Sorry, Wendy, I got confused. Yes. So anyway, PPP and EIDL borrowers, okay? 2 options that we have to help you. We have our personalized PPP strategy sessions, 30-minute call, just you and me and your PPP documents, where we can just kind of help, whether it's because you're ready to file forgiveness and you just want to make sure you're crossing your T's and dotting your I's, whether it's because you still have money left and you want to make sure you're spending it right, whatever the reason, sit down with us for 30 minutes. It's a recorded Zoom call. You'll get the recording, okay? And we can sit down and make sure you have everything, all of your ducks in a row. If you're not a DIYer, and you're like, I want nothing to do with PPP, I want nothing to do with forgiveness paperwork, I just take it. We do also offer full service forgiveness completion. So for that, you're gonna wanna schedule a free consultation with me on my website, which I should have also put in the comments and I keep forgetting. So we can just talk about your plan and pricing and structure and all that. So that is it for today, you guys. Let's see. Oh, Wendy says, if you are a W-2 employee and participate in a 401k plan, and you're self-employed, can you set aside a total of more than $19,500 a year? But this person's not older than 50. I cannot remember the answer to that question, Wendy. I'm trying to think, because I know that you can have a 401k and you can have an IRA. I just can't remember how the limits work together. So let me look that up, and I will get back to you. So I should know this. There's certain ways they can work together and certain ways that there's limits. So I just got to remind myself, so I don't want to tell you the wrong thing. So I will look that up and post it in the group. So that is it, you guys. I will see you on Thursday at 2:00 p.m. Mountain Standard Time. That is for updates and Q&A. Bring your questions. They don't have to be PPP and EIDL oriented, right? Bring your tax questions. Bring your accounting questions. Maybe we'll have some updates. Maybe we won't. But if we don't, I need questions to answer, so come join us. All right, or post them in the group if you can't make it and you want them answered. Post them in the group and I will answer them on Thursday. All right, you guys, take a deep breath. It's Monday. Have a fantastic week. I hope you started your week off great, and I will chat with you Thursday afternoon.